Hi, welcome to another segment of Governance Watch here at the Conference Board in conjunction with Egon Zehnder. I'm Doug Cha, Executive Director of the Governance Center here at the Conference Board. Today we're going to talk about what investors expect with regards to board governance. Our guest is Mary Clark. Mary is the managing partner of Each Win Capital, an investment management firm that focuses on U.S. public equity markets. And Mary is also a member of the board of Ally Financial Services, where she is the chair of the Risk Management and Compliance Committee and also a member of the Audit Committee. And joining us to be the moderator of our conversation is Francisco Perret, who is with Egon Zehnder, where he leads the Financial Services Practice Group for the Americas.
Thank you for being with us, Mary. It's good to see you.
Happy to be here, thank you.
Very interesting topic to which you bring an interesting perspective, both as a former operating executive, as well as an investor and a board member. But for now, let's focus on your perspective as an investor. Investors always talk about the importance of strategy and leadership in making investment decisions. But in founding and building Each Win Capital, you actually put leadership at the core of your investment approach. So in kicking off today's conversation, tell us about your firm and why you came to this fundamental tenet of leadership and talent as fundamental to your investor view. And then let's talk about the role of the board.
Okay, great. Thank you, Francisco, and thank you, Doug, for having me here. So Each Win Capital focuses on the U.S. markets. So we invest in publicly traded securities. And as you said, leadership is really at the core of what we do. And the reason we chose this path is because all of our partners had the experience of being in many organizations and following and watching the activities and results of many different leadership teams. And what we found, which is not a novel concept, is that there's a vast difference in performance based on the quality of leadership and managerial actions and the board itself. I came from an operating background at Morgan Stanley, where I ran several businesses. One of my partners was a semiconductor executive for 20 years. Another came from the media industry, and a fourth had a classical investment background. And all of us felt that not only is there a big difference in operating performance, but in fact that the market doesn't fully capture that difference. That is, that because most portfolio managers don't have operating experience and can't spend as much time on the subject as we do, that they are inclined either to be taken in by charisma, as is often the case, and there are many examples of that, or not being willing to fully ascribe a large enough premium to a truly effective team. And so we felt that hole in the market, if you will, would create an opportunity for us to deliver outsized investment returns to our clients, and that taking this approach would be a wonderful way to kind of screen and find opportunities, as well as then to evaluate opportunities and ultimately make our investment decisions.
Very interesting. Very interesting. Quite unique in the investment ecosystem, I would say.
We think so. As you say, many people talk about management, but really digging in and learning about the management teams takes quite a bit of extra effort. You can't just listen to them and what they tell you, because of course they're selling.
Sure.
As directors, we all know that we want our management teams to be selling when they're talking to investors. So one of our partners is actually an ex-Wall Street Journal reporter, and he helps us really dig in and find out what are these management players like when they're actually making decisions, by talking to people who've been in the room with them when that's happening. Another one of our team members has been a headhunter in the past. So like you, she brought to us the techniques of referencing, which helped tremendously when we're evaluating management teams.
Terrific, really.
So independent investigation, kind of like the journalists you're talking about. Yeah,
precisely. Yes, exactly.
Very interesting. So then, let's talk about how the board comes into play as a safeguard of shareholder interests as part of this investing approach?
So the way we think about it is the board sits at the top. It definitely should drive management's approach, if only by selecting the ideal managers, right? And again, what we find is the business of really understanding the board becomes a topic in the investment community, typically when there's underperformance rather than when there's high performance. And we believe that serving on a board is a team sport. And what we're looking for is high performance teams, right? And so, like any other team, there are typically roles and responsibilities amongst the players. And so the first thing that we look for, of course, is the right players. And that wants to be a mix of people with operating experience, often sitting CEOs or retired CEOs, but there also should be other disciplines that are represented. For example, you want somebody who really has the responsibilities and capabilities of serving on an audit committee. So somebody with a deep finance background. And similarly, when you think about the compensation committee, and particularly the chair of the compensation committee, it's important to make sure that that person is both unconflicted and also in a position to be able to lead the discussion of how management should be incented. And ultimately, that needs to be tied directly to strategy. So we have a number of ways of kind of evaluating the likelihood that the board is doing a good job. We start with, do we have the right set of players, and are they in the right roles? And then one of the real telltales is what sort of incentive arrangements have they created for management, right? So we believe that you really want to marry the investment hypothesis with the assessment of governance, right? We want to see the strategy of the company, we want to see it played out well, and we want to see that that matches management's incentives as driven by the board. And so when you see a set of incentives, and I'm not talking about the amount, I'm talking about the structure, that really match what we expect management to be doing in order to be competitive and to increase their competitive position, then we can infer, I think, that the board is switched on.
So you're coming up with a method to try to match to show causation as opposed to correlation, which is a classic conundrum for anything in corporate governance, to show that one actually leads to the other as opposed to kind of close correlations.
And this is the trouble when you look at these things from an academic point of view. You want to be academically rigorous, which leads you into a rules-based approach. And a rules-based approach, it is very limited when you're looking at variables that are actually situational, right? As we know, from having been around for a long, long time and been in this area for a long, long time, the right board is right for the right situation, and you wouldn't want to see the board of BlackRock, to pick one, to be operating a restaurant company, and vice versa, right? We want to see, and that has to do with the maturity of the company, its place in the life cycle, the industry itself, many, many things, right? And the governance itself also needs to play into that. Things like whether or not there's a poison pill. We actually own a company where there is a poison pill. We think it's a great thing for that company in this setting, as it is, right? But that requires digging in and really understanding the investment opportunity and marrying that with the governance.
Mary, you touched a couple of times on the importance of proper alignment of the board and management around strategy. I think it was Ben Graham, seen by many as the oracle of value investing, and quoted by Warren Buffett and many others over time, who said that in the short term the market is a voting mechanism, but in the long term it is a weighing scale, it's a weighing machine, meaning that in the short term it's a popularity contest, it responds to momentum. And in the long term, it reflects fundamentals, the underlying reality. You're a believer in long-term investing yourself. But how can boards focus on the short-term on the long-term direction and strategy of a company and reconcile that with the short-term pressures of the market's voting mechanism? What's your perspective?
I think it is a conundrum, and increasingly recently. But we believe in building value for the long term. It leads to sustainable investing. It leads to better outcomes for all of the stakeholders, we think. What becomes important in the short term is credibility. And so, and one of the things we believe is that there are many elements of a management strategy that they may not want to flag for the competition. So it's entirely reasonable not to communicate every single element of a strategy, and particularly at certain times. Certainly the board needs to understand the strategy, though, and support the strategy, and oversee the development of the strategy, if you will. But typically the strategy itself should spring from management's good thinking, its understanding of the competitive landscape, its understanding of what the customers need or might need over time. And so for us, the important thing is the long-term strategy, but then communicating what's going on right now becomes important to bring along employees, many of whom are compensated with equity, and financing sources, both debt and equity. And I think one of the purposes the board can serve is to focus on that balance between long-term and short-term, to allow management to have a sounding board to share some of these trade-offs with. But we find over and over again that the best companies are in fact building for the long term. They understand the patience required for various different investments to play out, and they're very conscious about building for the future, and knowing that they have to be able to play for the future, which means they have to be able to be effective over the next 6, 12, 18 months and so forth.
Interesting, but from the outside looking in, as an investor, how do you know when there is that constructive alignment between the board and management around strategy and long-term focus?
Well, again, I think the best clue is compensation, right?
Okay.
We are outsiders. We typically don't interview the board, although often we're able to talk to one or two directors for one reason or another, but obviously they have to be careful about what they say to an outside investor.
Sure.
And today, I think there's not necessarily a consistent venue for communication between directors and investors, so it can be a little bit more catch as catch can. But what you can watch is behaviors, right? And those behaviors are manifest in things like the composition of the board, right? A company that is trying to be forward-looking about the application of technology will often add a member to the board who has those kinds of skills or experiences.
Right.
And then, again, the compensation has all kinds of clues in it, right? Because there are short-term measures of performance as well as long-term measures of performance in a good compensation plan. And those are spelled out. We like to see some subjective measure of performance as well, because we think it's like anything else, that if you have that we're talking about, if you have a rules-based system, it can be gamed, it's sometimes not quite right. We want a board that is capable of making judgments. But again, I think the business of communicating what they're looking for through specific guidelines, which again are available to all employees and also available to shareholders, is very good practice.
You brought up something interesting. There are not many mechanisms for investors such as yourselves to engage with the board. And we're in an era that some would argue has seen a fundamental shift from a perhaps more differential model of engagement to a more skeptical, shareholder-centric model of engagement, as evidenced by increasing shareholder activism. So with that backdrop, how should boards engage with the investment community?
Well, I think boards should be proactive with investors. there are many different ways to initiate such a dialogue. One can be with one-on-one discussions with individual investors. I think sometimes people do a smart thing by bringing a few investors together in a relatively intimate setting where there can be real give and take, but to some extent where investors can get a sense for some of their own similarities and differences in terms of what they're looking for. Sometimes that can be useful, I think, in the company's attempt to communicate what it's doing. Sometimes a longer-term oriented shareholder will have some positive impact on it, maybe a more shorter-term focused investor. I'm a believer that the shareholder meeting is not adequately used today because it was abused by small shareholders over time. The shareholder meeting is a wonderful venue where typically all the directors are present, all the senior management is present, and very few investors take advantage of that. Instead, what we find is that in the recent, up until very recently, investor relations was really delegated to a staff member who reported to the CFO, and that person was responsible for coordinating, but also being a really important mouthpiece. And often that person has never sat in a boardroom, as opposed to, say, a corporate secretary, right, who sat in the boardroom many times, but typically hasn't had direct interface with investors on a regular basis. So I think there's still plenty of room for evolution and raising the bar in terms of how this communication happens. I've been a member of the Shareholder Director Exchange group that set the protocols, which I think has been a progressive sort of suggester of how each side should respect each other. And I hope to see more initiatives like that over time.
Yeah, but in terms of communicating the long-term view, it seems it's tricky these days to really articulate, why investors should be patient, what we call patient capitalism, when you have such pressure for short-term results. So how do you see that playing out in today's marketplace, especially with respect to increased activity by shareholder activists, hedge funds, et cetera?
So some very good work has been done by a group called Focusing on the Long Term, or Focusing Capital Long-Term Initiative. And I think one of the critical points they make is that there are many groups of shareholders who get evaluated on a short-term basis, and that leads them to then, in turn, evaluate management teams on a short-term basis. And this is a very unfortunate thing, if you will. But look, to me, directors have a fiduciary responsibility to think about value. And when you really think about value in a big picture way, it's awfully hard to escape the notion that value is not created in a day, and that tomorrow's stock price simply isn't the measure of effectiveness or the driver for building over time. And so I really think directors have a huge responsibility to stand up to the pressure that has been circling. One of the things we talked about a little bit in preparation is that, and it goes back to this notion of a board being a team sport. I've been in boardrooms where one director is really advocating short-term performance and another was really advocating a longer-term perspective. Again, I think this can be healthy in that balance that we talked about at the outset, but I think, again, this notion of how you actually build value in a corporate or large organization setting, it just cannot be done overnight. And I think directors are in a much better situation to understand that than an investment manager with no operating experience, right? So given that different level of expertise, I think it's just really important to own that as a director and as a team, a board of directors. But that means you do have to articulate both the long-term strategy and the short-term goals in a way that somebody who may not understand the business all that well can learn it and grasp it. And that often means repetition. It means patience in the delivery of the message, if you will. And it's often very much helped by human interaction, one-on-one, where questions can be asked and answered, and there's a really healthy dialogue with a respectful attitude on the part of the communicators, as well as on the part of the recipients, right? But I think that
Yes.
the communicator has to take the lead, if you will, and that's
Yes.
why I make this point about I think investors really have to stand up to their roles.
Yes.
It's called leadership, right?
There you go. Exactly.
Mary, you started talking about constructive engagement by the board and some of the dynamics in the room, so to speak, at the board table. I'd be interested in your views in how your perspectives and experience as an investor inform your mode of engagement as a board director.
That's a good question. Thank you. First of all, I've sat in a lot of boardrooms over time, and I think I've seen lots of different kind of cultures, if you will. Today, as an investor, because I study boards all the time, I think that's kind of helpful in understanding the range of possibilities, if you will. And I definitely try to bring the benefit of that as well as the perspective of an investor to the boardroom. I'm not in a dialogue with all of our individual investors the way the company management is, but sometimes I can provide some perspective that's helpful, and I think understanding this tension between long-term and short-term in a very kind of direct way is also helpful. I am the one in the room who's focused on the long term and saying, don't worry, don't let these people tell you what to do. I know them.
Yes.
Right? But we know that we collectively are better than the people who are observing us, so
Yes.
let's do what we think is the right thing. It also does have some impact on how I think about new board members. Today on the Ally board, we have a fantastic nomination and governance committee. We started as a brand new company that was invested in by the United States as part of the TARP program, and so we started with a clean slate in terms of a board, and then for some period of time, the U.S. Treasury had a lot of impact on who our new board members were. But again, it sort of goes back to this idea that it's a team sport. So you want diversity in the team, and by diversity, I mean both the traditional ways of looking at it and the non-traditional ways of looking at that, right? A diversity of skill set, experience, and perspective. And I think increasingly a diversity of long-term view, if you will. So this notion that I talked about earlier of having, for example, people who are facile with technology and the direction of technology is just the sort of thing that you want on a board, and we see it. 3 years ago, one of the companies that we own that's in the water treatment business went out and specifically looked for an expert in cybersecurity. Really? I mean, they were so at the edge of thinking about what they might need.
Yes.
And they were fortunate to find a woman who was an Air Force general who had been responsible for the Air Force's approach to cybersecurity. And they kind of took a risk on someone who hadn't been a director before. But really, she was able to contribute so much to that board that now she's on the board of one of the major banks, where it's much more obvious that they have this cybersecurity need. So those are the kinds of things we love to see, and that I always have in the back of my mind when we're thinking about our own board.
Very, very interesting.
Yeah, thinking outside the box with something that you guys do in your line of work. So. Well,
that's right. I mean, we do a lot of board assessment work. And many best-in-class boards are really good about asking themselves, what are the questions in the room that we consistently don't have very good answers to, or where we might benefit from a new perspective. To the point, for example, about certain types of operational risk or existential risk, cybersecurity, terrorism, being technology, digital innovation being examples of such topics. Very interesting. Thank you. So Mary, given the fundamental tenet of your investing approach of which you spoke, I'm itching to ask you a question that I think I know the answer to, but it would be great to hear you talk about it. What's more important, the business model or management?
That's a great question. And I get asked that frequently. Clearly are both important. Warren Buffett says that, if you encounter a business with a poor reputation and a management with a good reputation, it's the reputation of the business that will win out. And I think that can be true. We certainly are attracted to good business models, and in fact, all talent is attracted to good business models. So by looking at the talent, watching the talent, sometimes you get good clues. But the more fundamental thing is that business models are conceived and created by human beings, right? They don't just spring out of the air. And the same goes for moats, defending a moat. That is dependent on the actions of people. So we feel really strongly that by looking for strong people, we will be led to strong business and investment opportunities.
Thank you.
Well, that's it for this episode of Governance Watch. Thanks for watching, and we thank Mary and Francisco for being here, and our partners at Egon Zehnder. We'll see you next time.